Thanks everyone for joining and welcome to LPC's third quarterly market update for 2025. Bit about LPC. LPC is an independent tenant advocacy firm with 6 offices across Australia and New Zealand, and we are dedicated to representing occupiers in all aspects of commercial real estate and achieving tenant-friendly outcomes. We've observed that most of the market commentary tends to reflect the landlord's point of view. In contrast, today's session is designed specifically for tenants. Our team of experts will provide a high-level overview of the Q3 2025 conditions across office, retail and industrial sectors throughout Australia and New Zealand. And as always, this will be through the lens of the tenant. Joining me today, we have Julian, who will be discussing office, Adrian, all things retail, Ken, industrial expert, and Gillian will be providing statistical analysis around vacancy and occupancy in each sector. So agenda, we'll have the office market snapshot, retail market snapshot, industrial. We may touch on fit out guide if we get to it, and then a Q&A at the end. So just starting off, I'll share a few key insights from news articles published over the last quarter across both Australia and New Zealand office, retail and industrial sectors. So the pandemic put a pause on co-working boom of the 2010s, but now it's staging a bit of a comeback, driven by businesses demanding more flexibility and organisations wanting space that supports collaboration rather than simply just desks. The amount of co-working flexible space has therefore more than doubled in the last 3 years. Some co-workers have put bowling alleys and golf simulators in their tenancies to entice tenants. So what's the opportunity for tenants? If your business is adopting a hybrid or flexible model, you now have more options to match the model, allowing you to reduce your fixed commitment and letting you scale up or down more easily. However, these offerings generally come at a cost. The other article highlights the union's warning to employers: hybrid and remote working arrangements are increasingly becoming a negotiated right, not just an employer discretion. So what does this mean? The need for more flexibility, for one, is key, with break clauses and other flexibility rights needed to be negotiated in your leases. Julian will speak to the office market further in his section. Looking at retail, the retail sector, Australia's pipeline for new retail floor space is projected to decline by around 72% over the next 5 years compared to the 5 years prior to the COVID period. What does this mean for retail tenants? Greater competition for quality locations, upward pressure on rents, and greater importance of location. Adrian will help us navigate these pressures in the retail section. Finally, in the industrial front, industrial continues to be one of the preferred asset classes for large capital investment. What does this mean for tenants? There's a fight for modern, well-located warehouse, logistics space, and it's only going to continue to be tough. If you're leasing now or renewing soon, you'll want to act early, target the best stock you can access, and negotiate hard on flexibility and incentives. Ken will provide a further breakdown in the industrial section. So now we go to the office market snapshot. We'll have an overview of the vacancy data, the market stats, and then the tenant perspective.
Okay, thanks, Ed. So across the Australian CBDs, vacancy has nudged up slightly from 13.7 to 14.3% over the past 6 months. That's mainly because more than 200,000 square metres of new space has hit the market, outpacing demand. However, tenant demand was positive across all major capitals except for Perth. Location is playing a bigger role than ever. In Sydney, demand is centred in the core, while Melbourne, it's all about the Paris end of Collins Street. Outside the CBDs, vacancy has inched up from 17.2% to 17.3%, driven by softer demand and limited new stock. Looking ahead, with future supply below average and strong demand for premium grade offices, we expect vacancy to tighten at the top end. I'll pass over to Julian for more.
Thanks, Gillian. This slide illustrates the difference between lease norms and market conditions. The LPC barometer shown on this slide will appear across all sectors in today's market update. Each presenter will highlight where current market conditions and lease norms sit along the barometer, providing context for tenant strategies. In respect to the office sector, in terms of lease norms, the lease structures remain predominantly landlord-friendly, but incremental wins for tenants are emerging. The challenge for occupiers is to keep pushing for tenant-centric provisions, particularly around risk allocation, obligations, and guarantees. Progress is achievable, especially in markets where tenant leverage is strong. In terms of market conditions, the office market remains tenant favourable, supported by elevated vacancy levels and subdued demand. Many organisations are still consolidating and reducing their footprint, creating a shallow pool of active tenants. Landlords recognise that vacancy will persist in the short term, which opens the door for strategic negotiations and attractive deals for tenants who engage early and position themselves well. On the next slide, we will talk you through the key trends shaping office tenant strategies, what's driving decisions, and where the opportunities lie. The first one is flight to quality. We're continuing to see a strong trend towards a flight to quality across all major markets. Tenants are prioritising premium and A-grade buildings with modern amenities, ESG credentials, and wellness features. It's about attracting talent and future-proofing workplaces. For tenants, it's important to understand the viable alternatives to secure high-quality space, having regard to lease expiries and business requirements, particularly with forecasts showing a tightening in higher-grade office buildings. The next item is incentive and rents. When we talk about rents, the critical metric is effective rent, not just the headline face rent. Effective rents reflect the real cost after incentives, such as rent-free periods or fit-out contributions. While effective rents remain very competitive in secondary grade buildings, premium assets are holding firm on face rents, with some also reducing incentives. This is partly because the economic rent required to justify new developments has increased significantly, driven by construction costs, ESG compliance, and financing. As a result, we're seeing new highs in face rents for new buildings or new premium buildings, with existing premium buildings benefiting from these new highs. For tenants, this means two things. There's still opportunity to negotiate in secondary markets, and don't leave your run too late if you want premium space. Expect higher face rents and fewer incentives as landlords seek to meet these new economic thresholds. The third trend is investor sentiment. Investor confidence is improving as interest rates stabilise and pricing clarity returns. Capital is flowing back into core assets, driving refurbishment programs and upgrades. What does this mean for tenants? Quality stock will attract more competition as these upgrades come online, and landlords will have less need to offer generous incentives. Acting early allows tenants to secure favourable terms before a shift occurs. Sustainability and ESG. ESG reporting is now a core business requirement, especially for companies working with large corporates. Tenants are increasingly selecting buildings and landlords that help them meet sustainability targets through energy efficiency, green certifications, and carbon reduction initiatives. This is no longer a nice to have, it's a key factor in building selection. And finally, looking ahead. Looking ahead, vacancy will remain elevated in secondary stock, but premium supply will tighten. Hybrid work and space efficiency will continue to reshape demand. Tenants should plan ahead, consider shorter terms with options, or lock in longer terms in quality assets to take advantage of current market conditions. In this slide, we present our strategies for tenants, including the associated outcomes. We will continue to use this table in the different sectors and highlight the relevant strategies applicable to each, having regard to the current market conditions. Our primary recommendation for office tenants is to prioritise the lease restructure before expiry strategy. In particular, if premium space is part of your strategy, timing is critical. Investor confidence is returning, refurbishments are underway, and the economic rent needed to justify new developments is pushing face rents to record highs. Right now, incentives are still attractive, but they may not last. Acting early means you can secure high quality space on favourable terms before competition increases and landlords start pulling back.
Thanks, Julian. Now we move on to the retail market snapshot. We'll have a look at the leasing trends. We'll have then an overview of the large format, shopping centre and CBDs, and then we'll have a look at the tenant perspective. Over to you, Julian.
Okay, thanks, Ed. So as we turn to retail, performance remains mixed across sectors. In large format retail, vacancy is trending down thanks to steady demand and very little new supply. Other retail sectors are more stable overall, but we're seeing variation by submarket, with strip retail facing higher vacancy in some areas, while well-located shopping centres remain tightly held. Effective rents are still under upward pressure. In many markets, face rents are growing and incentives are easing back, showing continued demand for quality space. Looking forward, location and quality will be everything. Being in the right spot matters more than ever for tenants. Over to you, Adrian.
Thanks, Julian. So as Julian highlighted the barometers within the office market, lease norms in the retail sector remain largely unfavourable due to the strong supply side power and the collective market dominance landlords hold over retail tenants, further compounded by the restrictions imposed by retail leasing legislation. Market conditions across various retail types are quite varied. In theory, they should favour tenants in the current environment. However, many landlords are disregarding the many external pressures faced by tenants outside of their lease arrangement. Instead of trying to understand the pressures, they are prioritising their own financial position, ensuring they are not adversely impacted regardless of wider market conditions. With the retail market under stress from cost of living pressures and interest rates, landlords would benefit from taking a more supportive approach, helping tenants and fostering longer term relationships rather than creating further strain. So from a large format perspective, whilst discretionary spending is on the up, assisted by the last interest rate cut in August, most large format retailers are experiencing modest retail sales as the consumer waits for the upcoming Black Friday sales period in November. A shortage of available properties in the large formats retail sector continues to push face rents higher. Opportunities for new or relocation sites remain limited, and off-market negotiations are now more common. Net rents below $300 a square metre have become increasingly rare. As an example, a new LFR development in Melbourne's inner suburban area is currently asking rents in the mid $500 per square metre net range. Large format retailers are also becoming much more considered in their decision-making process, which is pushing out timeframes to conclude negotiations across the board. Those retailers who can move quickly to secure internal approvals will be in a position to benefit from securing sites in tightly held markets. Whilst most landlords are open to offering incentives on new sites, there has been a reduction in capital contribution for fit-out works, particularly among private or smaller landlords. Renewal incentives are almost non-existent due to rising borrowing costs, and expertise is required to extract as much value from the negotiation as possible. So with shopping centres, retailing remains challenging. Whilst rents continue to increase, retailers are also facing pressures from wage growth. This, coupled with longer and more discount periods, retailers are faced with falling profit margins. Ensuring that supply chains are working effectively is also a challenge. A number of retailers we have spoken to over the past month have experienced delays in stock arriving, as well as having the right stock for the right season. The ever-changing US tariff situation continues to make retailing challenging, with retailers exporting to the US facing fluctuating price adjustments, as well as being forced to consider different export markets. Shopping centre landlords are still seeking rent increases on renewal by 5 to 20%, along with longer-term leases and fit-out upgrades. Tenants in larger shopping centres continue to be affected by relocations on renewal, as landlords prioritise maximising turnover and rental growth by revisiting tenancy mixes and introducing new brands. As we discussed with large format retail, shopping centre landlords are only providing incentives on new sites, and even then the amounts are reduced or reflected within a higher face rental. CBD and fringe. So with CBD retail, vacancy rates are actually slowly starting to decrease in the CBD retail markets after a sharp rise during and after the COVID period. Positive trend within Sydney, Melbourne and Brisbane has been the investment in the metro train systems, with increased foot traffic in Brisbane and Sydney having a positive effect on the retail market, with Melbourne to also enjoy the benefits early in 2026. Suburban retail negotiations remain difficult for smaller tenants, as many landlords are reluctant to acknowledge their obligations when not in their favour. In a recent negotiation, a landlord was not prepared to offer a further term because, quote unquote, I don't give options, as options are only for the tenant, not a landlord. This is an example of the difficulties retailers face when negotiating with some landlords. New site selections. Retailers continue to be highly selective when evaluating new sites. With rising fit-out costs and ongoing economic uncertainty, tenants are prioritising locations that meet all operational needs, particularly visibility, signage and parking. Secondary sites that may have been acceptable pre-COVID are no longer being considered. From a landlord consideration perspective, to attract and retain tenants in the current environment, landlords must remain commercially realistic, set rents in line with market conditions, and understand the increasing pressures faced by retailers. So with this slide, there's a number of strategies that a tenant can enact to receive favourable outcomes within the retail sector. In orange, we've highlighted lease restructure before expiry that has relevance to the slide shown previously. With this strategy, commencing discussions well before the expiry date provides the time required to successfully leverage a tenant's advantage and market conditions to deal with and overcome difficult landlords with unreasonable requests. Thank you. I'll hand back to Julian.
Thanks, Adrian.
Okay.
Industrial market snapshot up next. We can have a look at the overview of the stats, the current status, the trends, and then again, the tenant perspective.
Thanks, Ed. So after years of tight conditions, vacancy rates are starting to rise in the industrial sector, which is bringing some relief for tenants and some more negotiating power. Effective rents are coming under pressure too, with incentives doubling in some areas and face rents down around 10% since early 2025. That said, supply is still tight. One of the key trends to watch is the premium prices data center operators are paying for land in Melbourne and Sydney, and this is going to create real competition for traditional occupiers. I'll pass over to Ken.
Well, thanks, thanks, Julian. As we've touched on in the previous sectors, we will touch on the barometer. The industrial market has predominantly been a landlord's market for the past decade, driven by strong demand and tight supply. Whilst, as Gillian mentioned, there are shifts towards demand and increasing supply, there is some breathing room for tenants in both market conditions and lease terms. The sustained growth has generally favoured landlords, pushing the balance further away from tenants. On the next slide, we'll explore practical strategies designed to help tenants regain negotiation power and create more balanced, tenant-friendly outcomes. In terms of the market status, ESG, occupiers are increasingly seeking green certified buildings, for instance, buildings that have a NABERS or Green Star rating to meet their corporate sustainability targets and reduce operational costs. Tenants with strong ESG mandates are prioritising facilities with the energy efficient system, solar panels, EV, CV charging and water recycling. It's about future-proofing premises and meeting the expectations of business targets and reporting. In terms of industrial, there is a demand shift. So, for instance, in Sydney and Melbourne, there is a demand for transport and postal warehousing that seems to be the strongest driver in Sydney, whereas in the retail sector, as Adrian mentioned, due to a drop in discretionary spending, demand for this space has reduced. In terms of the highest best use, what we are noticing across different capital cities is demand for various uses and in terms of the highest best use. So for instance, starting in Western Sydney, there is a demand for the last mile logistic hubs as as it is driven by the proximity to the new airport and major infrastructure projects. In terms of Brisbane and Queensland along the Trade Coast and North Lake, cold storage and food logistics are dominating that sector due to the easy access to the port and airport facilities. Moving over to South Melbourne, with the land constraints, the developers, similar to Sydney, are pushing towards multi-level industrial facilities. And in Adelaide, the area is moving towards advanced manufacturing, supported by the defence and skilled contracts. In terms of rent and incentive, as everyone is aware, industrial rents have surged by about 30 to 60% over the past 3 years, driven by the strong demand and limited supply. The good news is that the growth is moderating now, and landlords are offering higher incentive to maintain their headline rents. However, this isn't universal. In some tight submarkets where supply is scarce, rents remain elevated and incentives are fairly minimal. What are the market trends? Adaptive reuse. Industrial sites are increasingly being converted to data centers, as Gillian has mentioned, driven by the digital infrastructure growth and ESG priorities. Vacancy dynamics. Whilst the vacancy rates have inched up in some markets, offering tenants more choice, in some submarkets it is still fairly tight, so early engagement is critical for high demand locations. Tech integration, automation, AI, and smart building systems are becoming more standard in modern or new building facilities. This provides the tenant with lower cost energies, enhanced security, and the ability for them to meet their ESG targets. Nearshoring. This is reshaping the industrial property demand in Australia. With the global supply chain disruptions and rising shipping costs, businesses are reviewing their business needs and their options and looking at ways where they can bring production facilities closer to home. What are the opportunities for the tenant? Similar to the other sectors, lease restructure before expiry. Restructuring early will allow you to lock in favourable terms, whilst the market conditions swinging in the favour of the tenant. This strategy also gives the flexibility for a tenant to align the terms with the operational needs. Side deed variations at the edges. Sometimes you don't need a full lease overhaul, just targeted changes. The side deed lets you adjust obligations, add ESG requirements, tweak flexibility without renegotiating the entire agreement. This is ideal for businesses needing incremental changes to adapt to the ever-changing needs.
Thanks, Ken. We now touch on project services and fit out costs. This is our first time having Rebecca on the webinar, so we welcome her and we'll get underway. Thanks, Rebecca.
Thanks, Ed. Hi to everyone. It's great to be here. On the LPC website, we publish a series of occupier guides, which cover topics related to commercial office fit outs and relocations. Today, I wanted to highlight our fit out cost guide, which we recently updated using data from our own projects, along with input from quantity surveyors. As many of you know, office fit out costs can vary significantly depending on the age and condition of the building, the efficiency of the floor plate, and the level of design and finishes selected. This guide is intended as a budgeting tool for the early stages of your premises search and initial cost planning. Once concept plans or layouts or test fits have been developed, we always recommend preparing a detailed cost plan based on measured quantities. For simplicity, the guide classifies costs into 3 categories: standard, medium, and high quality, shown across the 3 columns. The rows list the key trades and inclusions such as flooring, lighting, and mechanical services, so you can see the step up in quality and scope between each category. Now, a standard quality fit out, previously when I started in this industry about 10 years ago, you could get a standard quality fit out for about $1,000 a square metre or less than that. It's up now closer to $2,000 a square metre. And they are typically more economical solutions that retain much of the existing base building infrastructure. They involve partitioning, but the partitioning will have little acoustic attenuation, and they make use of cost-effective furniture and joinery. With a medium quality fit out, these are up and around 3,500 at the higher end per square metre, and they will include a higher proportion of built space, improved acoustic performance, and a more refined standard of finishes and joinery. And finally, high quality fit outs. They start at $3,500 a square metre and above, and typically feature bespoke finishes, but it'll also include an intertenancy stair or commercial grade kitchen, reflecting a higher level of craftsmanship and amenity. If you have any questions on these, please feel free to reach out.
Thanks, Rebecca. We have time for a couple questions. Feel free to put some to us in the Q&A section. Firstly, had one for the office sector. So Julian, with some of those premium assets, what sort of rents are they trying to target for those new developments?
So if you look at the new developments that are due in Sydney, as an example, that are due to complete in 2027, late 27, the tops of the building are around 2,300, which is what Gilbert and Tobin are paying at Chifley South. So that's for a large chunk of space. So that's getting up there. If you then look further beyond that time frame to some of the metro developments, overstation developments, then they might even be hitting the $3,000 mark in 2032, 33. And that
Perfect.
just pushes up all the other premium rents behind it, existing builds.
So Julian, just to confirm, that's a rate per square metre, isn't it?
Yes.
Yeah.
Face, so that's not including an incentive, which you would get on top.
Perfect. Well, I think we can finish early today. Thank you everyone so much for joining us. And I think our next update will be in the new year. Hope you have all a great Christmas. And if you have any questions, please feel free to reach out to the team. And we'll see you all next February. Thank you all.